Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
So the floor is set. Apple, the $4 trillion market giant, is sitting right around 270-236 as we close out the year. What fascinates me is just the sheer scale of the consolidation we've seen this quarter. I mean, we saw the stock briefly touch an all-time high near 288 earlier in December, but the volume has since, normalized. It suggests a really fierce battle for this 270 floor.
That battle is the absolute key because the stakes are just enormous. The market is currently treating Apple not as the, let's say, reliable, slower growth hardware behemoth it once was, but as a high-octane software and AI platform. And that fundamental shift, well, it's reflected right in its price-to-earnings multiple, which is ballooned to around 36 times forward earnings.
And I think that 36 multiple is justified.
I disagree, fundamentally. Look, the central tension here is whether this current valuation is a sustainable reflection of the future agentic AI platform and this promised iPhone 17 supercycle, or if we're just watching an unsustainable speculative PE expansion driven by temporary market euphoria and a reliance on future growth that is just far from guaranteed.
Right. And I hold the position that the valuation is entirely justified. The strategic pivot is real, and the growth drivers are, I think, powerfully reinforced.
And I'll be arguing that the multiple is simply unsustainable, given the serious internal dependencies and, frankly, the external structural headwinds that are currently capping the stock's true potential.
I see why you think that, but let me give you a different perspective, one that's rooted in strategy. The market is, I believe, rightly re-rating Apple based on its structural transition. We're moving from a hardware company to an intelligent agent provider, and that warrants a premium multiple, something similar to a high-margin software-as-a-service giant. My argument really rests on two things: leadership and the moat. First, the appointment of Amara Subramania, a critical AI architect from the competition, that's a massive bullish signal. It resolves the long-standing market concern that Apple was an AI laggard. The move signaled that they are serious about competing at the highest level.
The signal is received, sure, but the execution risk remains.
But consider the execution support that's already in place. The iPhone 17 supercycle. We are projecting a 6.1% year-over-year shipment increase, which is substantial for a company of this scale. This upgrade cycle, it isn't based on marginal design changes. It's what I'd call a forced upgrade. Why? Because the core features of Apple Intelligence require the new neural processing unit, the NPU, in the A-series and M-series chips. This hardware necessity just reinforces Apple's legendary moat, driving the adoption of the entire ecosystem deeper than ever before.
I come at it from a different way. That 36 times PE ratio is historically rich, bordering on astronomical, for a company whose underlying growth rates are often confined to the low single digits. Despite its massive, $416 billion in revenue, you're pricing in utter perfection, which leaves, no margin for error. My concerns are rooted in verifiable operational risk. My primary point of evidence is the critical capability dependency. The material confirms Apple is licensing Alphabet's powerful Gemini model reportedly for $1 billion annually. This is not a sign of strength. It's an acknowledgement of a major internal capability gap. You can't claim to be an unassailable ecosystem fortress when the brain of your new AI Siri is reliant on your direct, aggressive competitor.
But that's precisely where the strategic genius lies. I'm just not convinced by that line of reasoning because you view that billion-dollar fee as a sign of weakness, whereas I see it as tactical pragmatism. It is an immediate, necessary investment that instantly solves the critical generative AI time-to-market problem.
Time to market is crucial, granted.
Exactly. It buys Apple the necessary runway to accelerate the development of its own proprietary agentic AI, focusing its internal silicon, the M5 chips, on creating truly efficient, privacy-centric on-device models. This is about disciplined resource allocation. They secured a high-performing external model instantly while protecting internal resources for long-term differentiation. I mean, Dan Ives, the Wedgebush analyst, characterized this entire move, the leadership change and the Gemini deal, as a major reset intended to put them on the right track. It's an acceleration strategy, not an admission of fundamental long-term failure.
That's a compelling argument regarding pragmatism, but you have to look at the qualitative risk. Paying $1 billion annually to Alphabet suggests that Apple's internal AJAX models were critically insufficient to stand alone, or else they wouldn't have made this move. This operational dependency, it challenges the fundamental thesis of Apple owning the stack, from chip to cloud. Furthermore, there is deeply embedded skepticism in the market. You only have to look at influential retail communities to see pervasive sentiment. The pervasive complaint that Siri has always sucked. This historical context means the market risk of delayed or subpar AI execution is exceptionally high. If the new Apple Intelligence iteration isn't transformative, that 36 times multiple collapses instantly. The market is waiting for a truly flawless execution, and dependency on arrival makes flawlessness much harder to guarantee.
So you're arguing the qualitative skepticism outweighs the clear quantitative improvements coming from the super cycle and the services segment.
I'm arguing that the skepticism is warranted because the dependency limits their strategic flexibility. But let's move beyond the strategic transition and look at how this stock is actually trading day to day. We need to discuss the plumbing of the market, the dark pools and microstructure.
This is often overlooked, but critical for understanding the price movement.
Precisely. The data shows heavy off-exchange short volume ratios for AAPL, frequently fluctuating between 28% and over 46% of total volume. On December 19th, we saw a spike to over 10.2 million shorted in off-exchange venues. For the average listener, this might be interpreted as massive institutional bearish betting, that smart money is actively shorting the stock, putting constant technical pressure on price discovery and capping upward momentum. This structural resistance is a real impediment to breaking out past 288.
I'm not convinced by that line of reasoning, because the high off-exchange short volume is perhaps the most misunderstood data point in modern finance. It's almost entirely a feature of market microstructure related to how retail orders are filled. We're talking about wholesaler internalization, governed by rules like Regulation NMS.
Okay, explain that for the sophisticated but, non-quant listener. Why does that short volume not mean institutional bearishness?
Certainly. The vast majority of retail buy orders, say someone buying 10 shares of Apple through a popular brokerage, is sold to a market maker, a wholesaler, who executes that trade off-exchange to give the retail buyer a slight price improvement. When that retail investor hits buy, the market maker must fill that order instantly. They often sell the share short to the customer immediately, and then, almost simultaneously, they buy the share on the public exchange to flatten their position. It's a hedge, not a directional bet.
It's the mechanics of filling the order.
Exactly. Therefore, that 10 million shares shorted on December 19th, counterintuitively, is a powerful quantitative signal of immense retail buying demand and persistent popularity. The retail army is absorbing the supply, providing liquidity and the foundation. Furthermore, our analysis of the large block trades that are reported suggests that large institutions are consistently accumulating at the 270 level, establishing a truly robust floor of support, entirely contrary to the bear short volume narrative.
Okay, I accept that the internalization mechanism explains much of that specific off-exchange short volume. But even if the stock is being supported by retail flow, we have to return to the issue of whether 36 times is justified, regardless of who is buying. You keep referencing the services segment growth, but that high-margin revenue stream is not immune to economic reality.
That revenue stream justifies the multiple expansion. We have a services segment that generates over $100 billion annually with margins exceeding 70%. That's fundamentally different from the, 35 to 45% margins we see on hardware. The potential for new subscription-based recurring revenue streams, like the rumored Apple Intelligence Pro subscription, fundamentally justifies the PE expansion from the historical 15 to 20 times range to 36. This is not superficial inflation. It is a permanent re-rating reflecting a shift toward higher margin, more predictable SaaS revenue.
That's a compelling argument, but have you considered the acute sensitivity of this valuation to macroeconomic factors? The moment you price a company based on revenues 5, 10, or 15 years in the future, it becomes what we call a long-duration asset.
Meaning its value is highly weighted toward future, not immediate cash flows.
Precisely. And the valuation of any long-duration asset is extremely sensitive to the risk-free rate, which is essentially what investors can earn safely, like on Treasury bonds. Current monetary policy projections suggest the Federal Reserve will implement slower, fewer rate cuts throughout 2026 than previously hoped. Slower rate cuts mean interest rates stay higher for longer. This translates directly to a higher discount rate used in valuation models.
And a higher discount rate
Inherently compresses the present value of those profitable future AI and services revenues you're banking on. This macro headwind validates the skepticism implied by traditional models. Our own discounted cash flow estimation, adjusting for a slightly higher perpetual risk premium, places the intrinsic fair value significantly lower, closer to $223.69. The stock is currently trading nearly 22% above that intrinsic value because the market is ignoring the elevated discount rate risk.
I appreciate the mathematical rigor of the DCF model, but it often struggles to capture the optionality of a platform shift, like the move to agentic AI. Furthermore, the services moat creates a natural hedge against some macroeconomic volatility. However, I want to pivot back to the structural supply issue you raised earlier, because it is the biggest tangible headwind we face in the near term.
The Berkshire Hathaway phenomenon. It's a mechanical ceiling.
It is. Berkshire has been systematically trimming its immense stake throughout 2024 and 2025, primarily to mitigate portfolio concentration risk. They simply don't want a single stock to be 40% of their holdings. This systematic trimming acts as a persistent headwind. Every time Apple rallies aggressively toward 290, this institutional selling absorbs the liquidity. This pressure will continue until their internal portfolio allocation targets are met, likely well into the first quarter of 2026. You cannot sustainably break major resistance when one of the world's largest investment firms is standing ready to sell.
So we agree this creates a physical, quantifiable lid on the price.
We agree on the mechanism, but not the long-term implication. Because conversely, we have to recognize the immense stability provided by current retail sentiment, which acts as the floor. The prevailing attitude characterized by the do nothing equals win meme among casual investors demonstrates that average investors view AAPL as the market's ultimate fortress, or reliable bond proxy in an increasingly volatile world.
The stability trade.
Exactly. And look at the behavior of sophisticated retail traders, often called the Theta Gang. They employ yield farming strategies, selling covered calls and cash-secured puts primarily in the tight $270 to $280 range. This means they are making money specifically by betting that the stock won't move much in the short term. This establishes a strong passive floor of support. It's independent of institutional rebalancing and provides the foundation necessary to maintain the $4 trillion market capitalization, absorbing that Berkshire selling pressure without a massive breakdown.
It is fascinating to see the institutional ceiling counterbalanced by the retail floor. But ultimately, stability doesn't justify a 36 times multiple when dependency risk is confirmed.
And dependency risk doesn't negate the immediate, quantifiable revenue boost from a hardware supercycle that redefines the platform.
To summarize my perspective, I readily acknowledge the power of the consumer moat and the necessary success of the iPhone 17 supercycle. However, the 36 times PE ratio feels overly aggressive priced for perfection, given two verifiable constraints. First, the dependency risk on Google's Gemini for core AI capability undermines the ecosystem narrative. And second, the mechanical supply pressure from Berkshire Hathaway will continue to absorb upward rallies, keeping a physical ceiling on the price until Q1 2026. The transition risk, despite the ambition, remains significant and, I think, underappreciated at this valuation.
And I reassert that the current consolidation around 272 is merely a digestion phase. The market is successfully absorbing the initial institutional rebalancing and the dramatic leadership change. The underlying bullish signals from record services margins to the hardware moat reinforced by the required NPI, are accelerating the justified re-rating. We're seeing clear smart money option sweeps positioning for a Q1 2026 rebound, suggesting the stock is technically primed to break the 288 resistance once the agentic AI execution is formally validated in the upcoming earnings report.
So this entire debate really centers on two questions. Does the current price accurately reflect the execution risk inherent in the strategic transition and the impact of higher discount rates on future value? Or
Does the current price reflect the inevitable and justified re-rating of a company that is successfully transforming itself into the world's premier intelligent agent provider?
it's clear that fully appreciating the blend of structural growth drivers, the serious dependency risk on rivals, and the unique market microstructure dynamics characterizing Apple in late 2025, well, it requires balancing multiple, often competing perspectives before any conviction on the sustainability of the $4 trillion fortress can be formed.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.